Hi guys, good morning. The third topic we are going to see is cash flow techniques for project evaluation or financial appraisal of project. These cash flow techniques divided into two types: non-discounted cash flow method and discounted cash flow method. Non-discounted cash flow method again subdivided into average rate of return and payback period. Under payback period method, we have three subdivided methods: traditional payback period, payback profitability, payback reciprocal. Under discounted cash flow method, we have various types of method, that is discounted payback period method, net present value, profitability index or benefit cost ratios, adjusted net present value, internal rate of return, modified NPV and modified IRR. This slide we see how we will calculate these methods. Under a non-discounted cash flow method, first one is ARR is equal to average annual profit after tax divided by average investment into 100. That is, we need to find average for all the annual profit for various year and divided by average investment. Then payback period method. Under the traditional payback period, here we see two scenarios. Under this method, we see when cash inflows are uniform, that means cash inflows we are receiving will be uniform for all the period in its life. For this, it is easy to calculate, that is cost of investment by annual cash flows. Whereas when cash inflows are not uniform, we will calculate by interpolation method using cumulative cash flows. This will be seen in the illustration. Next, payback reciprocal, which is the reciprocal of the payback period. Post payback profitability, which is equal to cash inflows for all the period life of the project minus cash outflow. Then under discounted cash flow method, discounted payback period is equal to payback period at which cumulative present value of cash inflow, which is equal to the initial investment. Net present value is equal to present value of cash inflow minus present value of cash outflow. In this, we need to keep in mind, that is depreciation should be added back to the cash inflow after deducting tax. That is, we usually calculate tax after deducting the depreciation. Then after deducting the tax, we need to add back the depreciation amount to the cash flows. Profitability index is equal to present value of cash inflow divided by present value of cash outflow for non-conventional cash flow, whereas for conventional cash flow, present value of cash inflow divided by initial outlay. What is mean by non-conventional cash flow? Here outflow will be in the subsequent period too, whereas in the conventional cash flow, outflow will be only in the current period. So when it occur in the subsequent period, we need to find the present value also for the outflow, not alone inflow. Okay. Adjusted NPV is equal to NPV. So along with the NPV, which is calculated in the second method, we need to do some adjustment, that is add the tax savings on the interest which is paid on the debt minus cost of equity issue. Next, fifth one, IRR is equal to discount rate at which present value of cash inflow is equal to present value of cash outflow. Modified IRR is equal to nth root of aggregate future value of cash inflow divided by aggregate present value of cash outflow minus 1. This is for non-conventional cash flow. For conventional cash flow, nth root of aggregate future value of cash inflow divided by initial investment minus 1. Same, for non-conventional, we need to find present value of outflow, whereas for conventional, no need to find the present value for initial investment. Modified NPV method, which is also known as terminal value method, it is equal to present value of future value of cash inflow at different reinvestment rate minus initial outlay. That means we need to find the cash inflow. That means we need to find the future value of cash inflow at different reinvestment rate, and then we need to find the present value for the future value. Then what are the critical issues faced in various method we are choosing, and what are the method which we use to overcome those issues? Under non-discounted method, it will not consider the time value of money. So whereas we can use discounted method for overcoming these issues. If project have different in size and life, payback period method will mislead in choosing the project. So payback reciprocal and post payback profitability can be used for overcoming these issues. NPV method will be inappropriate for similar life but different size of proposal. So profitability index method can be used. Project financed by higher proportion of debt to get benefit of leverage. This can be calculated using adjusted NPV method. Profitability index method. Small project with high profitability index, low profitability index may generate high NPV in future because different investment pattern. In IRR method, what we are facing is difficult in case of multiple IRR, different in inflow, size of investment, and life of the project. For this, we can use modified IRR method. NPV and IRR method itself have issues. That is assumption of constant reinvestment rate. So modified NPV and modified IRR can be used to overcome these issues. In the next video, we will work out the illustration sums under different method. Thank you.